Hello everyone and welcome. My name's Elliot Gu. I'm founder and editor of Smart Bonds. And today I want to talk about three specific reasons why I believe all individual investors should consider putting a portion of their portfolios into bond, preferred stock, and credit market exchange traded funds, or ETFs. Now I do realize that idea, that concept, is a little unconventional these days. After all, the mainstream media seems to really hate bonds right now. And a lot of individual investors I speak to are convinced that returns in the bond market have been terrible in the last couple of years, both in absolute terms and certainly relative to the stock market in the S&P 500. And I think there are a couple reasons why, and I'm going to show you why both of those ideas are total misconceptions and completely untrue. But I also think that there's some reasons why this is the case. One is that, of course, in the mainstream media, they're always going to chase, and financial media as well, they're always going to chase sort of emotion and excitement, and they're going to always tend to focus on what most individual investors own or can relate to. And in most cases, that is stock market, and in particular, it's the S&P 500. And I think the second big issue out there is that a lot of individual investors, and really even people in the media, conflate the idea of the bond market with treasuries, with US government bonds. They seem to think that the only bond investment out there is treasuries. And of course, that's totally not the case. And a related issue, if you buy the S&P 500, you're in a sense in a momentum play, right? It's market cap weighted, so the companies that have the largest companies also have the highest weight in the index. So when you buy an ETF, like for example, the SPDR S&P 500 ETF, symbol SPY, you are really buying mainly, most of your money is going into the largest stocks in the index. So over time, the stocks that do the best are going to become bigger and bigger and bigger, and therefore they're also going to make up a larger and larger and larger portion of the S&P 500. That's why you see sectors like technology within the S&P 500 having such a dominant, record-setting dominant weight in the index. So the same concept doesn't really apply to the bond market, because unlike the stock market, the best performing sectors within the bond market, the best performing niches within the bond market, aren't necessarily the largest. For example, as I mentioned, the US government bond market is the largest segment of the bond market here in the US particularly. And therefore, if you attempt to buy an ETF that tracks the US bond market as a whole, by definition, it's going to have most of the money that you put in there, most of the assets under management are going to be in US government bonds, which has been one of the worst areas to be in the bond market in the last couple of years. Also, your traditional aggregate bond funds aren't going to have any exposure to anything other than fixed income. So in other words, you will have mainly exposure to treasuries, some corporate bonds, some mortgage bonds, but some of the other bond-like investments out there, or like, for example, preferred stocks or senior bank loan market, they're not going to show up in those aggregate bond market indices at all. And those have been some of the best performing sectors within the bond market. Now, the good news is that over the last few years, ETFs, exchange traded funds, have been listed on the major US exchanges that allow you to invest in almost any imaginable niche of the US and global bond market. So you actually can, simply using your normal broker and these publicly traded ETFs, you can access markets that you could not access just a few years ago. So at this point, let's jump into the three major reasons why this is worth doing. And this is exactly what we do in the Smart Bond service. But let's jump into the main reasons why I think this is something you should consider looking at. Now, the first reason is yields, okay? Yields, consistent income from your portfolio. Now, I don't think it's any secret that the stock market doesn't offer much yield right now. And I pulled a few numbers to sort of put some meat on these bones, as it were. The S&P 500, and the most common ETF for tracking the S&P 500 is the SPDR S&P 500 ETF, which, as I said, trades under the symbol SPY. That currently has a yield of 1.21%, just a little over 1.2%, and it pays those distributions quarterly, so just once a quarter. The S&P 500 Equal Weight Index, which instead of being weighted by firm size, by market capitalization, it puts the same amount of money in each stock within the S&P 500. It does offer a little higher yield, 1.59% today, but that's still pretty low, still just a little over 1.5%. Now, outside the United States, yields tend to be higher. One of the most popular ETFs that I follow tracks all stock markets outside the all stock markets in the world, excluding the United States stock market. The yield on that is 2.92%, so a little under 3%. Again, better, certainly, more than double the yield you're getting out of the S&P 500, but still less than 3% yield there. And it also only pays those dividends or distributions on a quarterly basis. But even if you look at some of the high income or dividend focused ETFs here in the United States, the yields are pretty low, right? The Vanguard High Dividend ETF, very popular ETF that tracks dividend paying US stocks. The current yield is 2.63%, okay? The iShares Select Dividend ETF, which is one I'm asked about a lot, symbol I believe is DVY. That has a yield today of about 3.7%, so a little higher. But again, all these ETFs pay dividends or distributions on a quarterly basis. Now, on the fixed income side of the equation, and I'm going to start by focusing on what most individual investors seem to think is the only game in town in fixed income, which is the U.S. Treasury bond market. You can get some higher yields out there. The iShares 3 to 7 year ETF, which is symbol IEI, this tracks U.S. government bonds with maturities between 3 and 7 years. That offers a yield of about 3.24%. And those dividends, those distributions are paid monthly instead of quarterly. These distributions from that ETF are paid on a monthly basis. Still not a great yield though, right? And I'm going to give you some ideas that'll get you a little higher yield here in just a minute. The iShares 7 to 10 year ETF, again, 7 to 10 year US government bonds, very popular name. Symbol there I believe is IEF, right? That offers a yield of 3.71%, also paid on a monthly basis, so a little higher. And then the 20 plus year ETF, with the iShares 20 plus year Treasury bond ETF, which invests in long-term US government bonds. Symbol there is TLT, probably the ETF I'm asked about most often, and actually not one of my favorites right now. That does offer a little higher yield of 4.4%, but as I'll talk about a little later on in today's presentation, it does have an awful lot of interest rate risk. When yields go up on government bonds, prices go down, and this ETF can get hit hard. In fact, in 2022, we actually saw the TLT ETF show a bigger negative return, so it did worse than the stock market in that year. So not what investors are traditionally looking for when it comes to bonds. Again, something I'll talk about in a little bit in a moment. Now, one ETF that I do think is a good name to take a look at if you're looking for a cash substitute, so some place to park cash that offers a yield, you can look at the iShares 0 to 3 month Treasury ETF, which invests in Treasury bills, right? So it has very little interest rate risk whatsoever. Right now, that's offering a yield of about 4.2, a little over 4.2%. My favorite Treasury bill focused ETF right now is actually one called, as I said, the iShares 0 to 3 month Treasury bill ETF. The symbol there is SGOV, so SGOV. And that's a great name to park cash as a cash alternative. However, as I'll show you a little later on, you're not going to get much more than that monthly distribution paid. You're not going to have exposure to some of the themes that can generate total returns well in excess of that annualized yield. And again, this is something I'm going to talk about a little bit later on in this presentation. But let me just say that if you are more selective and you look at some of these other niches of the bond market outside treasuries, you can find yields that are far higher than 4.2, 4.3%. Now, we have three model portfolios in smart bonds. We have a baseline model portfolio, which invests only in bond, preferred stock, and credit ETFs. We have a defensive portfolio, which is the same, but it also is designed to generate less volatility, less risk. And we also have a dynamic 60-40 portfolio, which uses systematic and discretionary factors to allocate between a portfolio of bonds and broader stock market ETFs, mainly the S&P 500. Now, the Smart Bonds baseline portfolio, right now, here in late June of 2025, offers a yield of 5.42%. And the vast majority of the ETFs in that portfolio, all but one, actually pay distributions on a monthly basis. So you're getting monthly checks, monthly paychecks, distribution paychecks, and the total annualized yield is 5.42%, which, as I said, compares to the S&P at 1.2%, compares to these dividend ETFs, which yield up to 2.6 to 3.7%. You're getting a much higher yield out of the baseline model portfolio in smart bonds than any of those. And unlike those stock ETFs, it pays distributions. Most of the ETFs I recommend there pay distributions on a monthly, not a quarterly basis. Now, I'm going to give you one specific name just to give you a sort of flavor of what I'm talking about. Now, there's a segment of the high yield bond market. This is what we used to call the junk bond market. Some people still do. I tend to do that as well. But basically, these are bonds, corporate bonds. They're issued by companies with with below investment grade credit ratings. So the major bond rating agencies rate them a little bit below investment grade credit ratings. Now, what differentiates the fallen angels segment of the high yield bond market from the rest of the high yield bond market is that these are bonds issued by companies that were previously rated investment grade but have been downgraded to junk bonds, so below investment grade or high yield bond market. So why would you care about that? Well, the reality is, over the long haul, we've found that fallen angels, so bonds issued by companies that were previously investment grade but are now rated below investment grade, have tended to offer stronger total returns with less volatility, therefore less risk, than the broader high yield bond market. So most of the bonds issued in this ETF are rated one notch below investment grade. And in many cases, what we've seen in the past is that these bonds were temporarily downgraded to junk status, but over time, these companies regain their investment grade credit status, and that gives you a little bit of a lift here. Now, the beauty of this market is it offers far higher yields than the Treasury market, and it actually offers less interest rate risk, so less exposure to swings in interest rates. Right now, this ETF, it's the iShares Fallen Angels ETF. Currently, it trades under the symbol FALN. Currently, it offers a 6.7% annualized yield paid monthly. So far higher than you're going to get out of treasuries, and far higher, even long duration treasuries, which are very exposed to interest rates, and far higher than you're going to get even out of these high yield or dividend focused ETFs here in the United States. And you're getting that yield paid monthly instead of quarterly. Now, you might say, well, yeah, but who cares if you get this yield, but the total return is down because the actual ETF drops in value? And that's certainly been the case with some Treasury ETFs in recent years, which is why that's not a huge portion of the model portfolio in smart bonds. But it's not true of FALN. For example, over the last year, since June 28, 2024, the total return, which is capital gains and distributions, monthly distributions from FALN, has been a little over 9.8%. So almost 10% there over the past year, with a fraction of the volatility that we see in the S&P 500. Now, I'm going to talk a little bit more about risk and total returns here in a minute. In fact, those are the next 2 points I want to cover in this video. So let's roll right into that. So that brings me to the second point that I wanted to cover on today's video, and that is risk. Now, I think this is actually something that does attract many investors to the bond market, and that's the idea out there that bonds are less risky than stocks. They have less volatility than stocks. Therefore, your returns from the bond market are sleep easy compared to the stock market. And, that certainly can be the case. However, it's not always exactly the case. Actually, in some market environments, certain types of bonds can have even higher risk than the S&P 500. And when I talk about risk, what am I really talking about? Well, when most people talk about risk, most professional investors talk about risk, what they're really talking about is price volatility. So the volatility of your portfolio or the broader stock market or some index that you're tracking. So how much does the price tend to go up or down over time? And so we actually have a standardized measure for that, which is the annualized standard deviation, the annualized volatility of returns from whatever it is that you're trying to evaluate. So let me just put let me just throw up some baselines there for you. First of all, since June 28th, 2024, which is the last trading day in June, basically exactly 1 year ago, since that date, the annualized volatility from the S&P 500, the SPDR S&P 500 ETF, is 20.6%. So just to give you an idea of what volatility is, that's what it is for the stock market, a little over 20%. Some of you may have heard of the VIX, the volatility index. This is basically tracking the same thing. Annualized percentage volatility, in that case priced into the options market. But this is actual historic volatility for the S&P over the last year. So readings above 20.6% would be higher risk than the S&P over the last year. Readings lower than 20.6% would be less risk in the S&P for the last year. Now let's look at year-to-date so far in 2025. So we're almost halfway through the year. Year-to-date 2025, the volatility from the S&P 500 ETF or the S&P 500 has been higher than over the last year. And that probably makes sense to many of you because if you were involved in the stock market in any way so far this year, you know that we had this big sell-off from late February through to early April related to things like tariff announcements, and then this big recovery. So there's a lot of day-to-day price volatility, some record-setting volatility for certain chunks of time in the U.S. market, something we haven't seen in decades. So year-to-date, the S&P 500 volatility is a little higher than it has been over the last year at 25.7%. Okay, now a lot of investors I talk to think that, dividend-paying stocks are by definition lower volatility than the S&P 500. Again, this is something that can be true, but either isn't always true or not as much as you might think. So I mentioned that iShares dividend index a little while ago, ETF a little while ago, the DVY ETF. I'm asked about this all the time. Personally, I don't think it's a great ETF, but over year to date, DVY has actually had annualized volatility of 19.7%. So almost as high as the S&P at 25.7%. So a little bit lower for sure, but not a great deal lower. Okay, so let's flip over to the bond market. Now here, I think you'll be surprised. Now, a lot of investors think the bond market's by definition less volatile than the stock market, and in particular, or carries less risk than the stock market, and particularly government bonds, right? U.S. government bonds. After all, the United States government pays in dollars, and it can print dollars, right? So there isn't any assumed credit risk from the United States in Treasury bonds. But that doesn't mean there's no risk. The main source of risk so far in 2025 and over the last few years hasn't been credit risk, which the Treasury doesn't have, the US government doesn't have. It's actually been interest rate risk, right? Because when interest rates go up, bond prices go down, they move inversely. And so this big campaign in the recent years for the Fed raising interest rates, trying to quell inflation, expectations for inflation, expectations for Fed policy have caused some wild swings in the Treasury market. Now remember, I said that the most popular ETF out there tracking the bond market is specifically tracks long-term Treasury bonds. Now it's that TLT, that iShares 20-plus year Treasury bond ETF. I say it's the most popular because it has more assets under management than any other bond ETF in the United States. Since June 28th of 2024, that ETF has actually had a volatility of 14.2%. So again, it is less than the 20.6% that the S&P 500 ETF has had over the same time frame. But probably not as much as many of you would think. Now, year to date, it actually has had the TLT has had annualized volatility of 14% compared to the S&P at 25.7%. But that's still pretty high. The long-term volatility from the stock market is right around that 15% range. So the last year and a half has been more volatile than average, but the long term, you're looking at that 15, 16% average annualized volatility. And TLT has had 14% average annualized volatility so far this year and more than 14% over the past year. So maybe not as low as you might think. Now, if we move to Treasury ETFs that track lower duration bonds, so bonds that have less volatility respective to interest rates, we call this duration risk. Bonds that have less duration risk, less interest rate risk, like the IEF, which is that iShares 7 to 10 year Treasury bond ETF, which I don't recommend in smart bonds, by the way. But that actually has had, since last June, annualized volatility of 6.5%. 6.5%. So somewhat lower, right? However, right, if you are willing to diversify into other niches of the bond market, as I said, the biggest source of volatility in the bond market over the last few years has been interest rate risk. And a lot of those aggregate bond market ETFs out there are heavily invested in treasuries, which have a lot of interest rate risk. In particular, those intermediate and longer term treasuries, which have more interest rate risk. So if you're willing to go beyond those segments of the bond market to other sectors of the bond market, like even the Fallen Angels ETF I just mentioned, FALN, that has more credit risk because those companies can't print dollars, right? And so therefore they have more credit risk, but credit risk hasn't really been the issue over the last couple of years. It's been interest rate risk. So that actually has had lower volatility than, for example, that 20-plus year Treasury bond ETF I mentioned. If you're willing to diversify into some of these other niches of the US and global bond market, now that's very important as well. This year, one of the things we've done in Smart Bonds is to add exposure to global government bond markets, global corporate bond markets, which don't have have exposure to what the Fed is doing. They have some exposure to what those central banks in those countries are doing, but they're not necessarily on the same schedule. So it provides you some offset to the volatility we've seen in interest rates here in the US. So the S&B, the Smart Bonds, baseline portfolio over the last year has actually had annualized volatility of just 3.4%. 3.4%. And again, we've done this through a few different things. First of all, we've diversified the portfolio out of just only treasuries, right? Pretty much only treasuries or mainly treasuries, into other parts of the bond market, other niches of the bond market that have less interest rate risk. I mentioned, for example, the Fallen Angels. Another one has been in funds that have a floating interest rate. So, for example, one ETF we recommend there, which has a yield of close to 8% right now, actually a little over 8%, is the FLBL, which is the symbol is FLBL, and it actually tracks a portfolio of senior bonds. So these are senior loans. These are loans made by banks that carry floating interest rates. So when the Fed hikes interest rates, the yields on those loans, the interest rate charged on those loans, automatically resets higher. Most of those loans are benchmarked to things like 3-month Treasuries or the secured overnight financing rate. So you have they automatically reset higher when interest rates go up. So that gives you less interest rate risk. You actually benefit from rising rates. And that has had lower volatility than, for example, those longer-term Treasuries as well. Finally, I mentioned that SGov ETF, which is very short-term Treasuries, T-bills, Treasury bills we call them, which has almost no interest rate risk and almost no volatility whatsoever. So at times when we were worried about rising rates, we've tended to have more money recommended in the model portfolio, more money recommended invested in those short-term T-bills rather than longer-term Treasuries. So through all those different strategies, we've actually kept the volatility of the baseline portfolio at just 3.4% annualized, which is lower than anything I just mentioned. Even the intermediate term Treasuries and IEF at 6.5% annualized, and certainly a heck of a lot lower than the 20% plus volatility we've seen in the S&P 500 over the last year. Now, one thing that I think is particularly interesting, that many of you may find particularly interesting, is that, as I said in the very beginning of this video, I'm not saying that you should put all your money in bonds. I'm saying that it should have a place in your portfolio. So one of the strategies we track in Smart Bonds is actually what we call the dynamic 60-40 portfolio. So this is a mixture of investments in individual bond ETF, bond fixed income preferred, and credit ETFs, right? As well as an investment in the stock market. In particular, most of what we do in Smart Bonds is just buy the S&P 500. We also have some exposure to an equal weighted S&P 500 ETF and a global stock market ETF, okay? So, but the most of it's just in the S&P 500 in that SPY ETF I've mentioned several times today. However, what's different than with the dynamic 60-40 strategy relative to a static 60-40 strategy, which invests in 60% in stock market, S&P 500, and 40% in bonds, is that we use systemic as well as, or a system, as well as discretionary factors to change our allocations of stocks and bonds. We also, rather than investing in just Treasuries or some aggregate bond index, which is mainly Treasuries, we use the Smart Bonds baseline ETF allocations to manage that 40% of the dynamic 60-40 portfolio that's in bonds. So we vary the 60-40 part. We also invest in, or we recommend investing in ETFs that are in the baseline portfolio of Smart Bonds. So we're kind of getting the benefit of more selective choices for ETFs on the bond side, as well as a strategy that's designed to sort of lower our exposure to stocks when the stock market falls, or at least lower our exposure to the S&P 500 when the S&P 500 gets hit hard. For example, earlier this year, one of the things that we did is our trend following system started to suggest there might be a problem with the S&P 500. We might see a sell-off there. We reallocated a lot of that money, or a portion of that portfolio, into the global stock markets, which have outperformed the U.S. dramatically so far this year. So the Smart Bonds Dynamic 60-40 portfolio over the last year, since the end of June, since June 28th of 2024, has had a volatility, annualized volatility of 11.12%. As I said, that compares to the S&P 500 at 20.6%. Now, here's where I think it gets interesting. And this will bring me to the third and final reason that I want to talk about today, which is total returns. But the Smart Bonds Dynamic 60-40 portfolio since June 28th of 2024, a year ago, has actually offered a return of 12.05%. 12.05%. Over the exact same time frame, the S&P 500 has produced a total return of 14.4%. So the Smart Bonds 60-40 dynamic 60-40 portfolio has produced 83.7%, almost 84% of the return of the S&P 500. However, the annualized volatility, the risk, is much lower. It's actually 46% lower volatility than the S&P 500. So you've gotten more than 83% of the returns with 46% less risk. Now, year to date, I think it's even more compelling here. Because we've seen so much volatility in the stock market, since December 27th, I calculate returns for all of our model portfolios and smart bonds on a weekly basis. So that's the last Friday in 2024. Since December 27th, the S&P 500 is up 3.96%. So it has not done particularly well since December 27th of last year. However, our dynamic 60-40 portfolio is up 5.3%. So it's actually beating the S&P 500 year to date. However, right, we actually have as well far lower volatility than the S&P 500. As I said, year to date, the S&P 500 has produced annualized volatility of 25.7% compared to the dynamic 60-40 portfolio at 12.8% year-to-date annualized volatility. So that's less than half the volatility for the dynamic 60-40 portfolio and a higher return than the S&P 500. So I think that this really shows the power of the bond market. If you're intelligent about it and don't just buy Treasuries, which is the largest bond market, but largest in this case doesn't always mean best. But if you allocate sensibly to different segments or niches of the bond market, and you deploy some basic trend following indicators and strategies for highlighting periods where you might not want to be invested in the stock market, or at least as fully invested in the stock market, you can actually dramatically lower your risk and achieve similar returns to the stock market, or perhaps a little lower, or in year to date a little higher, but over the long haul, probably nearly as high as the S&P 500 with dramatically lower risk. I'm talking 40 to 60% less risk depending on the year. And that brings me to the final portion of this video today, which is total returns. Now, as I said, a lot of individual investors I talk to are convinced, probably from the mainstream media, that the returns from the bond market have been terrible over the last few years and that the only game in town has been the stock market. Now, as I just showed you, that's not necessarily the case. There have been portions of the bond market that have not performed well, but there have been portions that have actually performed very well. So let's dive into that. Okay, so let's just back up here just for a second and explain what do I mean by total return. Well, what I mean is capital gains, so how much the ETF goes up or down, right? Negative capital gain in that case, and the yield you receive. In most bond ETF cases, as I said, that's going to be a monthly distribution. All but one of the ETFs we recommend pays distributions on a monthly basis. So the combination of that is your total return, and it can be positive or negative, obviously. And that's one of the things I think that a lot of individual investors don't understand. You know, just because you have a huge yield there, just because there's some bond ETFs, there's one in the portfolio that has a double-digit yield, it doesn't necessarily mean you're guaranteed to make money there, right? Because the value of that ETF can go down. And it has, some of them have interest rate risk, for example, that can cause the value of that ETF to go down, overwhelming any distributions you receive. As I said, there's a pervasive view out there, and it's stoked by the mainstream media, the financial media as well, that bond markets has been a terrible place to be in recent years. That returns from bonds have been negative or very low, certainly relative to the stock market. And there are a couple reasons why that view is out there, and I think the most important is something I've touched on several times today. And that's that, when the mainstream media talks about bonds, they're usually talking about Treasury bonds, U.S. government bonds. And when most individual investors are thinking about bonds, oftentimes, I find anyway, they're thinking about that TLT ETF, that long-term Treasury bond ETF, or maybe one of those other bond ETFs that is, like the IEF, for example, the 7 to 10 year Treasury bond ETF that tracks U.S. Treasury bond market. There's a view out there as well, a lot of people have, that the Treasury bond market, as I said, is risk-free. It is risk-free in terms of credit risk. It's assumed to be risk-free in terms of credit risk. However, right, that doesn't mean that there aren't other risks out there, the primary one being duration risk or exposure to interest rates. So, let's go back and look at 2022, for example, right? So think about Silicon Valley Bank. Do you remember Silicon Valley Bank? It actually went bankrupt in early 2023. One of the big problems, or the main problem that Silicon Valley Bank faced, is they were taking in deposits and they were making some loans, of course. But like a lot of banks, they have a huge securities portfolio, meaning they're invested in primarily government bonds. And as it turned out, they took in a lot of cash, right, during the 2020, 2021 boom in tech companies, which is the main industry that they serve. And they invested a lot of that money in U.S. government bonds, including some longer-term U.S. government bonds, right at the bottom of the interest rate cycle. Now, I'm not going to call that stupid. It kind of is, though, isn't it? But the reality is, if you buy a bunch of long-term government bonds with interest rates at global interest rates, literally at 5,000-year lows, the lowest level we've seen since recorded history going back to ancient Mesopotamia, right? Obviously, you're going to lose money when the Fed then has to combat a generational surge in inflation by raising interest rates dramatically. One of the most aggressive rate hike campaigns we've seen since the early 80s. So obviously, you're going to lose money. Silicon Valley Bank got crushed. Anyone who invested in an ETF like TLT got crushed, right? But that doesn't mean that all bonds have exposure to interest rates like that. So, let me just give you just a few examples out there. Going back over the last year. Again, if you bought TLT, you probably aren't that happy. The TLT ETF I see here over the last year, since June 28th of 2024 to last Friday's close, has lost about 0.8% of its value, including that yield, which is currently up over 4%. Okay, so even with that yield, the capital losses have been such that the overall total return has been negative 0.76%, almost negative 0.8%. But again, that's not something we've been recommending in smart bonds since last summer, and there certainly doesn't mean that all segments of the bond market have done poorly over this time frame. And let me give you just a few examples out there. Let's start with a fund that I recommended last June and was already in the portfolio last June and is still in the portfolio today, and that is the Vanguard Emerging Markets Global Government Bond ETF. The symbol there is VWOB, VWOB. All right, so I'm telling you about this fund because it's one I recommended a year ago, and it's one that's still in the model portfolio today. This fund buys government bonds issued by emerging market countries. So these are government bonds issued by countries other than the U.S. That are emerging market countries outside the U.S. However, these are bonds issued in U.S. dollars. So a lot of emerging market governments issue local currency bonds, which I'll get to in a second, but they also issue U.S. dollar government bonds. And so this particular ETF, VWOB, invests in U.S. dollar denominated government bonds issued by emerging markets. So you don't have currency risk there. Now you do have credit risk, but you don't have currency risk. However, over that period where TLT has been down 0.8%, which again is what a lot of people think of as the bond market. A lot of individual investors only know about this ETF or a handful of treasury bond ETFs. That ETF is actually up 10.12%, including monthly distributions paid and capital gains over that time period. So over the last year, a 10+% return from a bond ETF with a tiny fraction of the S&P's volatility, a tiny fraction of TLT's volatility, actually, because it doesn't have that same level of interest rate risk, has actually offered a return of over 10%. Now that is not at all bad, I think. There's a variable distribution preferred stock ETF that we recommend in the model portfolio. That's up 7.9% over the last year. I mentioned the FALN, the iShares Fallen Angels ETF. That's up 9.8% over the last year. Now, I will say that one of the things that we recommend right now is we actually have added more recently a emerging market local currency ETF. So this is an ETF that tracks government bonds issued by emerging markets, right, in their local currency. And we recommended VWAB a year ago, that's the US dollar one, because we felt that the US dollar could see some additional strength, or we felt there was some vulnerability in some of the emerging market currencies. So we recommended that one to start. This year, we've actually reduced our exposure to VWAB and increased our exposure to the local currency ETF, which is dramatically outperforming VWOB year to date. So I'd still like VWAB, but I do think that you should take a look at that local currency ETF right now. The other thing to note is that, as I said, TLT is the one that a lot of people know, but and maybe IEF, the 7 to 10 year one that's issued by iShares of US Treasury bonds. You don't really have to do anything even that exotic, right? So year to date, I see TLT is up about 2.13%. Again, total return. And that is since that December 27th, 2024, which is the last Friday in December, up through the close on June 27th of 2025. TLT is offered a total return of 2.13%. So it's positive, not high though, right? And again, a lot of investors look at that and say, well, the bond market hasn't done well this year. However, right, that VWAB ETF I mentioned, it's up 5.63% this year. That's actually beating the stock market over that time period. And that local currency ETF that I mentioned that we've allocated more money into and I actually prefer right now, that's up 11.1% year to date in 2025. You just don't have to buy long-term US government bonds. If one of the things I like to do when the interest rate cycle, when I think interest rates have peaked for the cycle, which is I believe the case right now, but I think that they may not fall very rapidly, at least intermediate term or in the short term. One of my go-to parts is what we call the belly of the curve. So it's not long-term bonds and it's not really short-term bonds, but it's that intermediate term. And one area I like here is actually intermediate term corporate bonds. So these are bonds issued by companies with sort of middle maturities, not long-term, not really short-term. And our favorite fund that tracks this section of the US investment grade corporate market, well, that's up 5.1% year to date. Since December 27th, which again, about a half a year. So it's almost a double-digit annualized return. So that's a pretty good return considering that's beating the stock market actually year to date on this basis. So you don't really have to go that far out the risk curve to find solid returns from the bond markets. You just have to not be stupid and buy long-term government bonds at the lows of the interest rate cycle. There is a time and a place for long-term US government bonds. I think we may see that over the next year. In fact, we have some funds in the portfolio, ETFs in the portfolio, that focus on long-term government bonds, but with a twist. However, right now, mainly I prefer other areas of the bond market that we track in smart bonds. So there you have it. I covered a lot of ground in today's video. We talked about the three main reasons I think you should consider bond, credit, and preferred stock ETFs as a portion of your portfolio. And those are much higher yields than you're going to get from the stock market, much higher yields than you're going to get from most dividend-paying stocks in the US or even globally. Lower risk, lower volatility than you're going to see in the stock market. We've actually had in our 60-40 portfolio, which uses a combination of stocks and bonds, we've actually managed to get about half the risk of the S&P 500 over the last year with 83 or 84% of the return from the S&P 500. So I think that's a compelling risk-reward balance there. Finally, total returns. It really is a myth that bonds have not offered good total returns in recent years. It's only true if all you focus on is longer term treasuries, or if you're buying sort of any treasury or any bond ETF that's exposed to rising interest rates near a historic low at interest rates we saw back in 2022. There are plenty of areas of the bond market that I've highlighted in this video today that are performing very well in absolute terms, and in many cases dramatically outperforming the stock market. I mentioned the Fallen, F-A-L-N ETF, the Fallen Angels ETF. I mentioned the Emerging Market Bond ETF. I mentioned even intermediate term corporate bonds this year have beaten the stock market with a fraction of the risk, because the belly of the curve is the place you want to be right now, I believe. So with those thoughts in mind, if you want to see exactly what I'm recommending in the Smart Bonds portfolio right now, all three of our model portfolios, our baseline portfolio, our defensive portfolio, and that dynamic 60-40 portfolio that I mentioned, in real time, we are offering a free trial to the service via the link you see below this video. Now, what that means is that we don't want any money today. You click the button below this video, just indicate that you want to give the service a test drive. And for the next 60 days, you can try the service, see all the alerts, all the issues we send out. We usually send out at least one issue a month, and then a longer quarterly issue, which we just released at the beginning of June, beginning of this month. You'll get all of that in real time. You can also interact with me, ask me questions. We offer ongoing Q&A from paid and full readers. And if you have any questions, you can use that. For the next 60 days, if you don't like it, if you don't think Smart Bonds is for you, if you don't think that bond ETFs have a place in your portfolio for the three reasons I outlined, simply cancel your membership, and you'll hear no more from us in terms of that. Your credit card will not be billed. If you decide that it is for you after that 60-day free trial period, just do nothing, and we will bill your credit card only after that 60-day free trial period has expired. So there really is no risk to that. We offer a monthly and an annual subscription option, and beyond that 60-day free trial period, we do offer a prorated refund. So I hope you found this information useful. I hope it at least gave you some fodder to think about why bonds have actually been part of a lot of wealthy families' portfolio, particularly for centuries, because of some of those advantages they offer relative to stocks. I think bonds are only not so popular right now, mainly because the mainstream media really doesn't have a reason to promote them. Most people are focused on the stock market. Most advertisers are interested in promoting stock ETFs, for example, not bond ETF. I think that's a huge mistake, and I think you're missing out if you're not interested in or at least have some exposure to these markets. It's easier than it's ever been before in my career because you can access all sorts of different niches of the global bond market via ETFs that you can purchase through your normal broker just as easily as you'd buy any large cap stock ETF or stock. So with that, thanks again for listening, and I hope to greet some of you as free trial readers to Smart Bonds here in the next few minutes.